What is going on, ladies and gentlemen? Today we are going to be talking to you about option expiration dates. Now this is a very key fundamental to options and it's very basic, so you guys need to learn this. But let's get right into it. Let's search up Microsoft and let's go into the options chain. Now as you can see, you got this expiring up here January 17th. You click on this and it'll bring up a bunch of different dates, all the way up to about 2 years away, which is kind of crazy that you can buy a contract 2 years away. They're very expensive, but if you can pinpoint where the share will be, this could be a very good play in the long term. Essentially, all the expiration means is that if your contract does not end in the money by this date, you will lose all of your risk and you'll make no money. You'll actually lose money because you won't get your initial payment back for when you bought the options contract. So it's very important to choose the right date when you're analyzing a certain stock and you're looking into buying an options contract, because if you buy this weekly here, you don't have that much time for the stock to go either up or down and get in the money. But if you buy maybe like a week or two out, yeah, the contract's going to be more expensive, but you'll have a way better chance of hitting the option, and you'll actually end up making more money than if you bought the weekly, because you have time and you can kind of gauge before you even buy the option how much the stock moves in a week or two of time, and gauge exactly what options contract you want to buy for that specific amount of time. So all in the money is on options contracts is if it's a call, your share needs to end at a higher price than the options contract strike price you bought it for. And if it's a put, it needs to end lower than the strike price you bought it for. So say we bought this 160 put, Microsoft would have to move all the way down to 160 in order for us to make money by expiration. And you also have to factor in break even, but I made a video all about break even, so be sure to check that out. It'll be in the description below. But once the share hits your break even price, any amount the share goes up if it's a call or down if it's a put, that's how much money you're essentially going to make by expiration, because you can exercise this contract if they ended the money. So say we had this 162.5 call right here, and Apple expires at 165 by January 17th, we would be able to exercise this contract on expiration and make $250, no questions asked, minus our risk, of course. You got to always minus your break-even price. And how you come up with that is because when you're buying an options contract, you're buying the rights to buy 100 shares. So if the stock was trading at 165 and you had the 162.5 calls, you'd be able to buy the 100 shares at 162.5, and then essentially you'd be able to sell them at 165, hence your $250 profit. And it's the same thing with puts, just backwards. Like I've said in almost every video, calls and puts are essentially the same exact thing, but they're literally the opposite. So it's very weird. Just try not to overcomplicate it, though. Now, if your contract ends out of the money, say we had this 165 call and it didn't ever go above 165 or our break even at all, we would actually lose all of our risk and we'd make no money. We would not be able to exercise this contract because we're not going to want to buy 100 shares of Microsoft at $165 and the shares trading at $164. And this is universal on all the expiration dates. All the later expiration dates do is give you time. They're a lot more expensive because the market maker is able to charge a lot higher of a premium on these contracts, because it's much more likely the stock is going to move in that direction given the amount of time. If you got like a month or two on your contract, it's a lot more likely you're going to reach your strike price rather than if you had a weekly and you bought the same contract. It's not very likely that Microsoft's going to move up $7 in a week, but it might move $7 in a month. Yeah, that's really all you need to know about expiration dates on options contracts. You just need to know about the break even, which I have another video on. You can go learn all about the break even. The later the date, the more expensive your contract's going to be, but the more likely it'll hit. And yeah, you just need to always remember that your contract needs to end above your break even if it's call and below your break even if it's a put before the expiration date, because come the expiration date, if you're not at your break even or on a put lower or on a call higher, you're going to lose all of the premium you put down for your options contract, and that's not good because you want to make money while you're trading. You don't want to lose money. So be sure to get time on your contracts because it's really helpful, especially if you can snipe a good price contract in one of these later dates and have a little more time. You'll have a lot more opportunity to make a bigger percentage, and you'll be able to kind of pinpoint where the stock is going to move a lot better, because it's kind of hard to pinpoint where a stock's going to move on the weekly or even 2 weeks. It's a lot better to get contracts out like 3 weeks, like a month, maybe even longer. Just depends how you want to play these contracts. If you don't have time, maybe playing the month or two out options contracts will be more beneficial to you because you don't have the time to sit here and focus on trading. But it's really all up to you. Everyone's going to be different. So if you have any questions, leave them in the comments below. I'd love to answer them. Come on the live streams. We're live, market open to market close, Monday through Friday, even on the Trading Fraternity channel. So be sure to come check us out live, and we'll answer any questions you guys have for us. And thank you for watching, and I'll see you guys in the next video.